If you're interested in trading covered calls, but you don't have enough money in your account to afford 100 shares of certain stocks, what do? Well, there's actually a brilliant options technique that is so capital efficient that it can essentially mimic covered call writing, but with much, much higher returns. In this video, we teach you this technique and share a real world example where the returns are 10 times higher by employing this technique. Hi, I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to develop numerous 7 and even 8-figure per year traders. We hope you agree this is the top YouTube channel to help you grow your trading account.
Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And one of the most common issues raised by traders from all over the world is the fact that their account sizes may be on the small side, and they're concerned that they won't be able to trade the strategies that we're teaching you here on our YouTube channel because they don't have enough capital to trade them. And that issue comes up a lot when we talk about covered calls, because the starting point of any covered call trade is to buy 100 shares of a stock. And that's easier said than done for some people because, for example, if you wanted to do a covered call on CMG, Chipotle Mexican Grill, well, that would require you to buy at a minimum 100 shares of CMG, which is currently trading at $2,065. And so to buy 100 shares of that stock would cost you $206,500 plus commissions. Well, what if your account only has, say, $5,000 in it? Are you just boxed out of making that kind of trade, even if you love the setup of that covered call trade and you think you'd make a huge profit on it? Well, the answer is that there's an option strategy that creates an incredibly cheap workaround to this problem. A strategy that allows you to essentially mimic a covered call trade that normally would require a huge amount of capital. Instead, if you enter the trade the way we're going to teach you in this video, you can execute it with a very small account. And in some cases, like the example we'll show you in this video, actually make more money than if you had a super large account that could afford a normal covered call trade. It may not sound possible, but it is. You're going to see. I want to do a really super quick review of what covered calls are so that everyone watching this video is on the same page. If you already know how covered calls work, just hang in there. This is going to be quick. A call option on a stock entitles the buyer of that option to buy 100 shares of a stock at a certain price called the strike price of that call option at any time after the call buyer buys the call option. The call buyer pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go way above the strike price of that call option, in which case the buyer can exercise his option and force the call seller to sell his shares at the call option strike price, which is lower than they're worth. But it's also important to keep in mind that at expiration, if you've sold a call and the market closes below the strike price of the call, then unless the call was previously exercised, the call expires worthless and the call seller just pockets the premium. So that's how a call option works. Now, a covered call starts out with your buying 100 shares of a stock and then selling a call option on those shares that you own, usually at a strike price at or above the stock's current price, at a fixed interval like once a month or once a quarter, something like that. And so a covered call can have two possible outcomes. If the stock closes at any price below the strike price on the day the call option expires, the trader just pockets that call premium he receives initially. But if the stock closes above the strike price of the call option he sold, then his shares get assigned, in other words, automatically sold for the strike price of the call he sold. And again, he pockets the premium that he originally collected for selling that call, but now he does not own the shares. So that's the way covered calls work. Okay, with that said, let's say that at the beginning of this year, you felt that after the bearish year last year, 2022, where the SPY was down about 20%, that SPY stock would be a good investment for you because you're buying it after it's been beaten down so much. And SPY does have a long history of returning to its all-time highs and really blasting through them. At the same time, SPY stock's dividend yield is just about 1.55%, which is pretty pathetic. And so if you're a trader, you'd like to glean some extra income from SPY. And so let's say that on January 20 of this year, you decided to buy 100 shares of SPY for $3.95 a share, and then simultaneously sell one SPY call for a price of $7.02. Now, let's take a look at the cash flow of this trade. And so as you can see, the SPY shares cost $39.05 because we had to buy 100 of them to have enough shares to cover our obligation to sell those shares at $4.20 if the market gets there by the time the options expire. And remember, we receive $702 for entering into that covered call because its price was $7.02, and these represent the right to buy 100 shares. So you multiply that by 100 to arrive at a final cash inflow of $702 for the calls, resulting in a net cost for the covered call trade of $38,798. What if you just didn't have that much money in your account, as many retail traders don't? What if you had, say, $5,000 in your account? Is that a deal breaker for you? Are you effectively precluded from making this trade? And fortunately, if you understand a few things about trading options, you'll see that the easy answer is no. And that's because there is an option strategy known as a call debit spread that will allow you to make essentially the same trade for a whole lot less capital. So let's explore that now. Let's say that instead of entering into a covered call trade, you instead went ahead and bought 3 of those 390 calls whose strike price is about 5 points below where the SPY was trading on that day, and sold 3 of those same 420 calls, with both of them expiring in May, just like the short call in the covered call example. Okay, now let's break down the cash flow of the call debit spread we just executed. And as you can see, the 3 long calls at the 390 strike, again, 5 points below where the SPY is trading, they're trading for $22.93, and they each represent 100 shares of stock. So we multiply that by 100, and we bought 3 of them, so we multiply it by 3, resulting in an overall cost of $68.79. But on the other hand, we sold those 420 calls the same level we sold them for in the covered call case, where we bought the shares simultaneously. And so those 3, selling for $7.02 a piece, result in cash inflow of this time $21.06, resulting in a total net cost of just $4,773, which is about 12% of the initial cost of over $38,000 in the case of the traditional covered calls example. Okay, so now let's move forward to the end of the day that the call options expired, May 23rd. And as you can see, SPY closed at 418.62 that day. And so once options have expired, you can assign a final value to them. And so let's break that down in the 2 cases we presented. So let's start with the covered call, just the traditional covered call profit. And as you can see, the shares have now appreciated to $418.62 a piece. So those are worth a total of $41,862. And the 420 calls expired worthless because the 420 calls only have value if the stock closes above 420, because there's no value to a right to buy shares at 420 when you can buy them cheaper in the open market. And so subtracting the initial cost of the trade results in a profit of $3,064, which is about a 7.89% return. Now, let's compare that to the result of the call debit spread trade. And first of all, let's look at the 390 calls. Now, at the very end of the trading day that they expire, the options market is going to assign them a value of the difference between what those shares are worth in the open market and what the owner of those calls can buy them for. And since he can buy them for $390, because that's the right he bought when he purchased 390 calls, then you subtract $390 from the market price, which results in $28.62, and each option represents 100 shares of stock, and we own 3 of them. And so those 390 calls are now worth a total of $8,586. And again, the 420 calls expired worthless with no value, just as they did in the case of the covered calls. And so subtracting the original cost of the call debit spread, we make a profit of $3,813, which is 79.88% of the original cost, as you can see. So that's a return of 79.88%. The return on the call debit spread is actually more than 10 times the return on the covered call approach. And so if you compare the two trades in this case, it was no contest really. The covered calls were not only more than 8 times more expensive, but they actually made less money and a very pedestrian return, whereas the call debit spread provided you with a comparatively tiny cost, actually more dollar profit, and a ridiculously good return. Now, we do need to point out that obviously you need to get the direction of the SPY right for this trade to work. And if you're wrong, you're probably going to lose more money on the call debit spread than you would on the covered call in most cases. But that's the trade-off for being able to get into the trade so much more cheaply than if you had to buy the shares and expend all of that cash initially just to initiate the trade. And so what I want you to take away from today's video is that you don't have to have an enormous account to take advantage of the basic principles of the covered call. By using the call debit spread, you're able to basically mimic a covered call with way less of an upfront cost, more income in some cases, and a tremendous return. Using the leverage of options, as we did in this video, is a key advantage that our traders on the desk here at SMB use all the time, and now you can begin to exploit that edge yourself.
Now that you've learned this powerful technique, you might want to jump in and employ it right away with your trading. But before you do, make sure you watch this video appearing on your screen right now, which shares the 5 deadliest cover call mistakes that most investors unknowingly make. It can apply just as much to this technique as it does to covered calls. So make sure to watch it before trading.